we are excited to host you in what should be an engaging and insightful full discussion. My name is Albert Boatin, and I'll be the moderator for this webinar. Now, the purpose of this event is to provide you with forecasts on trends that will shape the second half of the year and insights that would help you make informed investment decisions going forward. And to do this, I'm joined by seasoned investment experts from the wealth management team in the persons of Nana Wiafe Boama, a wealth manager at Axis, Gideon Amuininche, an investment strategist, and Peter Bewa, who is also seasoned investment research manager as well as wealth manager. And each speaker would have an allotted time to present in the agreed order, after which the remaining time will be dedicated to answering your questions. Do you have any questions come up during the session? We'll entreat you to kindly submit your questions using the Q&A tab that is at the bottom of your screen. And once you submit that, we'll do our very best to address your questions during the Q&A portion of the webinar. And so, without wasting too much time, I'll hand over to Nana Wiafe Boama to kick us off with his session of the presentation, which will be covering details of Axis Wealth's operation. So once again, you are welcome, and Nana, over to you.
Thank you very much, Albert, for the kind introduction. And thank you all to our participants for joining us this afternoon. We truly appreciate your time and interest in this webinar. So Axis Wealth Management is a financial planning and wealth advisory firm. We leverage technology to provide our clients with access to over 150 markets in 34 countries, managing portfolios across 27 global currencies. As a specialized wealth unit within Axis Pension Group, the premier pension trustee in the country, we aim to serve individuals with over 25,000 in investable or liquid assets, offering financial planning services and global investment opportunities. I will now outline 6 key reasons why we look forward to working with you. First and foremost, on to the next slide. First and foremost, we are primarily a financial planning firm. Before executing your wealth and money plans, we collaborate with you to develop strategies that leverages your current financial resources and future cash flow to meet your goals. These goals often includes retirement goals, university education goals for those who are aiming at sending your kids, to university outside or a private institution in Ghana, cash flow planning goals, estate planning, and risk, management, right? The second reason why we are desperate, to working with you is that we pride ourselves on our independence, right? We are not influenced by external entities, pushing high commission products that may not meet our client needs. And our independence also allow us to offer diverse products across many markets without any hidden commission arrangement, right? We aim at serving our client, and that is our only motivation, for what we do. And because of that, we are not in any commission arrangement with any providers of the product we use in meeting, client, wealth, needs. Thirdly, how do we execute our client mandate? On the next slide. We like to invest, our client money in model portfolios. Albert, let's go on to the next slide. We like to invest our clients' money in model portfolios rather than individual securities, as is done by many of our competition, locally. And a model portfolio is simply a collection of assets managed by professional investment managers, employing diversified investment approach to balance return and risk. So this approach ensures we manage, clients, assets to basically, meet, their goal in a properly, diversified portfolio. So you will not see us, selling or recommending or advising our client to say invest in one mutual fund or one product. When you come in based on your risk, preference and your investment objectives, right? We build a model portfolio, that meet, that risk preference, right? And return objectives. So if you are perhaps an aggressive client, you would see a lot of equities, ETFs, or index funds in your portfolio. If you are the typical risk averse, client, you'd see a lot of developed market, treasury, securities within your model, portfolio. The fourth reason why, we think you should, work with us is that our advisors are fiduciaries with right credentials, placing client interest above all else, right? We are very, very passionate about helping you achieve your financial goals and ensuring your interests come first, right? Now to, a very important reason why we feel we are well placed, to help you achieve your financial objective is investor protection, right? It is a concern, or it's been a concern to many investors, in Ghana over the last couple of years, given what we've gone through as a market. From banking sector cleanup and people losing money, from the macrofinance debacle and people losing money, from mark-to-market on mutual funds and investors having their monies, locked up. Now, how do we ensure, we offer our clients, that peace of mind, knowing very well that their monies are secured? Firstly, client assets, right, managed, by Access or advised by Access is completely segregated from the custody of the client assets. So what we do at Access is we provide advisory, service, but then your assets are held by a US broker dealer. And that US broker dealer is a well-reputable company listed on the NASDAQ, stock exchange, and has, regulatory capital of about 15 billion USD, over 10 billion above regulatory requirements, right? Again, for our clients who are onboarded onto our US broker dealer partner, your account is insured up to $30.5 million, dollars, right? And most importantly, the ownership of every security we buy for you are vested in your name, or is vested in your name, not a joint, custody, between, Access and you. And that is very, very, very important. During the DDEP, most clients, were, shocked to realize treasury bills they've bought in Ghana from their banks were not held in their name. So when, they wanted out of the DDEP, they woke up to the realization that those, treasury bills they wanted exempt from DDEP are part of the bank's holding. So before we do, every asset we buy is held in your name. If it's Apple stock we are buying for you, as an example, the Apple stock is held in your name. If it is US Treasury, it's held in your name. We feel, that is very, very important in ensuring investor protection. Now, the sixth reason why we want to work with you is we are very, very, transparent about how we charge, our fees, right? We charge the lowest fee in the industry, up to 1.5% of client assets are paid, in advisory fee, right? That is the only fee. There are no penalties for withdrawing your money, unlike our competition who may charge up to 6% in front load fee, right? And an additional annual management fee of up to 2.5% because of the mutual fund they recommend to you. Our fee is a flat 1.5%, and that's the maximum, right? There's no penalty for withdrawal. There are no other hidden fees. And when you want your money, it is your money. You can have your money anytime you need access to your money. Lastly, we are committed, to the next slide, we are committed to working with you throughout your entire life journey, right? Not just managing your money, but then our objective in working with you is to ensure, we are helping you fulfill and meet your financial objective, as and when you go through life. So from investment planning, helping you, save, to meet your retirement, goal, right? Helping you to meet your children's, college education, and then helping you to transition, your wealth, nicely when you are ready, to go, back, to your maker. These are the services we provide, and that is how we help you in achieving, your entire, life, goal. So it would be an utmost pleasure, to work with you after this call. If you want to explore, further, you can reach out and then we'll have a discussion. Thank you very much for your attention, and we look forward to the opportunity, to work with you. Gideon, over to you.
Okay, thank you very much, Nana, for the introduction, and thank you all our cherished participants for joining this webinar. We really appreciate the time you are making. So in this economic review, I'll talk about some key macroeconomic indicators that shape investor expectations and also influence the markets in which we are invested, basically the fixed income and the stocks market. And on a general or on a headline level, what we've noticed in inflation is that it has been on a disinflation trend. It has been slowing down, and that's a good thing for markets. On monetary policy, we've also seen that the rate of hiking has slowed down, and probably that seems to suggest or signal that that has come to an end, and we should be seeing some easing going forward. And then on global GDP growth, what we've also seen there is despite the hardship and hard economic backgrounds, countries have been resilient or posted resilient growth, and across board, economic activity is picking up, and we expect to see the forecasts that are displayed here come to reality. And on returns, what we've also seen on the markets is that both Q1 and Q2 were very good for both the stock markets and the fixed income markets. We saw some positive returns being posted there. And then I'll hand over to Peter, who would give us the outlook for the markets. Now, moving on to inflation, or narrowing down on inflation, I think inflation has been very topical after COVID. And if I should take us back a little to 2022, we saw a surge in global inflation. If you look at the graph displayed on the left here, you would see that global inflation came out at 8.7 against the historicals that we see for 2021, 2019, and going downwards. That was a very steep increase. But in 2023, we saw it slow down to 6.52, and in 2024, we are expecting that it would slow down to 5.8. Now, the major regions that we have exposures to, which is basically the US and the Euro area, which we've been monitoring quite well, you see that they are all contributing to this decline we are expecting to see at the end of the year. In US, the last print that came out for inflation, there was a decline on a year-on-year basis to 3%. And that was basically held by a decline in energy prices or consumer spending, which is basically driven by energy and housing spending. Again, if you look at the graph indicated here, against the beginning of the year, US inflation was somewhere around 3.4%. And so, the inflation trend has been ongoing. And it's been the same story for the Euro area, where we started the year at 2.9%, and currently the last print that came out is at 2.5%. It's similar story for emerging markets area. So generally, monetary tightening that we see ongoing, and also the fall in commodity price or energy prices has been driving this disinflation trend that we've seen so far. On the next slide, where I'll talk about monetary policy, I think if I should take us a little back or again, we saw that most central banks, the US Fed, were all persistently hiking interest rates to keep inflation or to cool inflation down. And this hiking regime that we saw, if you look at the graphs here, we've seen that the hiking has been stable for a while. I mean, we've seen stable rates or interest rates being maintained by the central banks, and we are expecting that the hiking, it sends a signal that the hiking regime seems to have peaked or come to an end, and we should see some easing going forward. If you look at the euro area graph, that has already begun. I think the last decision that was taken, there was a decline of 25 basis points, which sends a strong signal that there's not going to be a hike, or we should see further easing going forward. And it's the same story for the euro emerging markets area. And so monetary policy has been tight, but we don't expect to see further hiking or increase in monetary policy rates going forward. Now, on the next slide, where I'll talk about GDP growth, what we've seen is GDP growth has been resilient despite the hard economic environment. There has been some surprises though, because even though there has been disinflation trend, there have been the fast pace at which we're expecting it to come hasn't, rolled out that way. There have been some delays, and narrowing down to the US, the last GDP print that came out for the first quarter of this year was 1.3%, which fell below investor expectations. And we can see or relate it with the current inflation level, which seemed to constrain consumer spending. It's been the same story for Euro area, where GDP growth has been 0.3% for the first quarter of this year and 1.1% for emerging markets area. But for the regions that we have high exposures, which is the US and the Euro area, going forward, we still expect GDP growth to pick up. We are not expecting to see any recession coming soon. So that's the expectation we have for GDP growth. Moving on to the next slide, where I'll talk about the equity market returns. Our focus here will be on the first quarter, the last two columns. That's the first quarter 2024 and the 2Q 2024, which is the second quarter. And if you look across board, we have the S&P 500 index, the NASDAQ 500, the Russell 2000, and an index that tracks the Euro area and emerging markets area. For Q1, it was a very good period. We saw very strong and positive returns being generated on these markets. For the second quarter, it was a similar story for the S&P 500 and the NASDAQ, which mainly tracks the large cap stocks. But for the Russell 2000, which covers or tracks the small cap stocks, we did see some negative returns, and we can attribute that to the level of inflation and the decline in consumer spending. But generally, returns have been positive and good on the stock market. Moving on to the next slide, which also shows the returns on the fixed income markets with focus on the last two columns. That's the first quarter of this year and the second quarter. We did see generally positive returns being generated by these indices. The US Ultra Shorts, which also shows or tracks short-term treasury bills in the US markets, the US Treasury bond, which tracks the bond market. We have the investment grade, that's the IG, and the high yield. We did generally see positive returns being generated. If you look at the investment grade bond for the second quarter, that's the only index that posted a negative return. But even that, it was a positive. So even though it's been a mix of small negative returns and largely positive returns, returns have been generally positive across both markets. So that brings the review to an end. I'll hand over to Peter, who will take us through the outlook.
Thank you, Gideon, and thank you to all of our participants for taking time of your busy busy schedules to join us this afternoon. Really appreciate your participation. Before I get into the outlook for the rest of the year, I'd like to do a quick recap of where we are year to date as far as the markets go. And so we continue to see the economy slowing down. Particularly the US, we've seen, US still continue to be the strongest economy in the world. It's slowing down, and there's a ripple effect in other parts of the world. So we've seen GDP gone from around 2.6 last year to the latest numbers being around 1.3. We're expecting Q2 GDP to come out in the next few days, and also revision, in a couple of weeks' time. But we see the economy is slowing. We also see inflation trending lower, whereas we had inflation about 9% 2 years ago. Due to the Fed's, rate hike policies, inflation came down to around 4.5% last year, and continues to trend down. The latest numbers they came out with inflation was the Fed's preferred inflation number, which is the PCE. It came in at 2.6 year over year, and month over month was even or flat. We expect that trend to continue. Also, we're seeing unemployment starting to creep higher. We started the year with unemployment around 3.6. It's currently at 4.1. And so we've seen, the unemployment situation slightly getting high. It's not it's not in danger territory yet, but it's slowly creeping high. And these two phenomenon will give the Fed reason to start cutting rates, anytime soon. We also see consumer spending slowing. So if you juxtapose inflation having been high for a really long time, just now starting to trend down, and seeing unemployment going up, it's impacted consumer spending a lot. There was all the stimulus that was passed during COVID, which led to cash reserves, piling up for consumers, and all that has kind of been spent down. Now we're seeing increasing credit card balances, and also delinquency rates have started to creep up in the US and other parts of the world. And so that has resulted in consumer spending starting to slow down. However, we've seen corporations, still reporting record, profits. And so corporate earnings has been really high. The expectations have always been exceeded over the last year as far as companies reporting. That trend has been continuing this year. The tech space, especially companies like NVIDIA, continue to report record profits. Even though expectations were increased, they're always exceeding that expectation. So that has also helped to drive the markets higher. So with all that being said, so far this year, as Gideon just alluded to, market performance has been strong, both in Q1 and Q2. All major indices are in positive territory across asset classes and style boxes. So both fixed income and equities are doing really well this year. Next slide, please. As far as the sectors year to date, so the sectors that have been outperforming so far this year have been communication services, which is typically driven by ad spending in the digital world. So this whole AI phenomenon has resulted in a lot of ad spending and driving communication services really, really high. We also see a lot of strong performance in the tech space, particularly the chip manufacturers and semiconductor manufacturers, and also software companies. So those particular areas have driven Infotech to record highs this year, and it's been really, really strong performance, kind of almost neck and neck with comm services. The next sector that has done really well is financials, which had earlier on been underperforming due to a number of factors, but particularly regional banks' exposure to the commercial real estate that were under a lot of stress last year. So coming out of COVID, with all the work from home, a lot of these buildings ended up, remaining empty. A lot of these high rises in big cities were not fully occupied, and the cost of maintaining those buildings, continued to stay high, whereas the revenues from occupancy wasn't coming. And so with higher interest rates, a lot of these loans that had to be refinanced at higher rates, let a lot of the owners walk away from these buildings without, refinancing them because there were no employees coming in to work, and then they had to still, maintain them at higher debts. So that led to a crunch in the commercial real estate sector sometime last year, around second quarter, and that impacted, parts of the financial services industry, particularly the regional banks. And when there's a pullback in that space, it kind of drags down the whole entire sector. And so banks have been undervalued, but recently they rebounded, and it's become very, very attractive because valuations are very low, and there's a lot of long-term opportunities in that space. And so that started to perform really well, and that's the third outperforming sector so far year to date. Areas that have been underperforming year to date include real estate, which was mostly due to the commercial side of things really pulling the whole sector down. But other areas in the real estate space continue to maintain. But the sector as a general sector has underperformed the markets year to date. We also seen another performance in healthcare and materials. Healthcare is primarily due to a lot of regulations that have been passed by the current administration. That's not really been very, very helpful to the sector. And then materials, primarily due to the extensive lockdown that took place during COVID and even after COVID, places like China. It took them a while to start opening back up, and then they still haven't recovered fully from the impact of COVID. And so demand for materials, which includes all the minerals that are mined for industrialization, as well as the EV markets, that has all not materialized. And that's why materials have been struggling year to date so far. Next slide, please. So with all that being said, our outlook for the rest of the year continues to be positive. We expect inflation to continue to trend lower. So lower inflation expectations, that trend that has already started, we think is going to continue. We expect the trend to go towards the Fed's target, which is 2%. We may not see that 2% this year, but we think we're going to get close to that target. We'll likely see the 2% inflation target towards the end of next year, 2025. We expect unemployment to continue to creep higher. We think that by the end of the year, we should be around 4.2, 4.3%, with the starting the year around 3.6. That is definitely creeping high. And so with the Fed's primary mandates being keeping inflation low and unemployment high, those two pieces are all trending in a direction that will lead the Fed to likely cut rates this year. So the markets are currently anticipating at least one rate cut, probably in September, and possibly another one in December after the elections. So we think that rates are going to start coming down. We've had stable rates since July of last year. That was the last time the Fed raised, and they've maintained all this time. This is the longest pause that the Fed has ever done in the history of the Federal Reserve. And we think that the next move is most likely going to be a rate cut. So that's what the markets are anticipating, and that's going to be a tailwind for markets. But we also expect the economy to continue to slow down from where we were last year due to consumer spending slowing, and also the running out of all the stimulus that was passed during the COVID era, and increasing consumer credit card balances. So those will all lead to a slowdown in the economy, and we expect that the soft landing that has been talked about so much will likely be experienced or manifest. So we don't expect any recession on the horizon anytime soon. However, the Fed was likely going to be able to achieve the goal of slowing down the economy without tipping it into a recession. So that's what the market is anticipating at this point. Next slide, please. Now, where do we see the investment opportunities? So we still continue to believe that there's a lot of opportunities in the United States, being the #1 economy in the world. The economy continues to be resilient, although consumer spending is slowing. consumers are still in a strong position. If you have unemployment around 4.1%, majority of the population is still employed and have the means, to spend. So the U.S. economy continues to grow strong, and we think that there's opportunities there. The caveat to that will be valuations have been very, very high. So some sectors currently look very, very rich and expensive. And so one has to be selective as to where to invest in the US market. And that's where active management, comes in. We think that even though rates are going to come down this year, it's still going to be high for longer because it's not going back. We're not going back to the 2% interest rate or 0% interest rate anytime soon. And so even if the Fed does 2 or 3 cuts, even if they do 2 cuts this year and do about 4 cuts next year, it's not going to be 25 basis points each time. And that's not going to take the current rates at 5.5 or 5.25 much appreciably low down where we are currently. So we think that rates are going to remain higher for longer, and that also represents investment opportunities, especially in the fixed income space. And so one can still continue to clip, 5% yield in money markets and good high quality fixed income, products with very minimum risk. We also seen the trend on reshoring where due to the supply chain constraints that occurred during COVID, a lot of developed economies were overly reliant on China. And the lockdowns that went on there, in addition to some of the trade tensions, that were introduced during the Trump administration, most economies, particularly the US, are doing everything to diversify away from reliance on China. And so there's a lot of manufacturing jobs that have been brought back to the US and other parts of the world. And that also represents investment opportunities, in the United States. When we talk about developed international, we're referring to, Europe and Japan. We've seen a slower economic growth compared to the US. The rebound from COVID has not been as robust as we've experienced in the US. So there's opportunities in developed international, but is limited compared to what we're seeing in the US. The other problem with developed international is aging demographics. So the population seems to be aging with not much, younger population coming to replace the older ones. And if you add that to the immigration policies most of these countries have adopted, doesn't bode well for an expanding working population. And we're also seeing higher inflationary pressure compared to what's going on in the US. One other point on developed international, and that's interesting. So for the first time in Japan, for instance, there were more deaths than births recorded. A lot of the companies that make baby diapers have actually started making more adult diapers than baby diapers. So that goes to tell you, what the future looks like for some of these aging economies. The opportunities we see in emerging markets, are mainly driven by reshoring and industrialization. So as I mentioned earlier on, there's been an effort to diversify away from China. And that has led to a lot of manufacturing jobs being, developed in areas such as Mexico and Brazil. One of the countries that has been the biggest benefactor of that trend is India. And so a lot of the US, companies that were relying on Chinese suppliers have invested so much infrastructure in, developing sources of, inputs from India. India is projected to be the 3rd largest economy in the next 2 or 3 years. And India has actually grown so fast over the last 4 years that, it continues to look very, very attractive. And we think that trend is likely to continue, for the long term. So that makes areas outside of China in the emerging market space, continue to be attractive. We've started seeing some of that reshoring potentially, also coming onto the African continent. But we need to, kind of put in place the infrastructure to be able to support, that trend in the long-term future. But so far, emerging markets also continues to offer a lot of opportunities. And if you add that to the fact that the valuations are very attractive compared to places like the US, it makes emerging markets one area to also pursue investment opportunities. Next slide, please. So where are we seeing tactical opportunities? So with everything that has been said so far, we still continue to like information technology or the tech space due to this whole AI phenomenon. So chip manufacturers, semiconductor manufacturers continue to look very attractive. We still think that we are in the very early innings of this whole AI phenomenon, which is currently perceived as the fourth industrial revolution. We think that this AI trend is going to continue for a very long time, and companies that have already started taking advantage are continuing to look very, very attractive. And there's still other parts or other iterations to that phenomenon that are yet to play out. We also like communication services, partly due to the whole AI phenomenon. We think that the two sectors are very, very closely related. We like industrials. That's another opportunity set due to the reshoring theme that I mentioned earlier on. And we also like financials, basically due to the valuation. And banks have very, very strong balance sheets coming out of the last financial crisis. And they've been able to show up, their balance sheets, make them resilient, and also look very, very attractive as far as valuation goes. So those are the four sectors that we are overweight to. And our underweights include utilities, which do not really do well when rates are higher, because investors can get high yield from fixed income without the risk of investing in equities. And so most investors would prefer to invest in fixed income when rates are high, and that's not is not boded well for utilities so far, and we expect that to continue as rates remain high for longer. Real estate is also an area that we're still underweight to, and then consumer staples. Those are the areas that we do not like. The other sectors that are not mentioned here, we are market neutral. Next slide, please. So this brings me to the end of my prepared remarks. We'll open the next session up for Q&A, and I'll hand it over to Albert to go through that for us. Thank you for your time.
Wonderful, wonderful. Thank you so much, Nana, Riafe, Gideon, and Peter, for the great and insightful presentations. I think it was some of the insights I picked were along the lines of the fact that we are optimistic on economic growth prospects as well as market performance going forward, despite some of the inflationary pressures and also certain the prints from the first quarter of the year falling behind targets. However, we still remain optimistic and bullish on investment and specific sectors, as Peter guided us through with his presentation. And so as Peter mentioned, we'll not waste too much time. We will zoom straight to the Q&A portion of the webinar. However, I would like to mention that if you joined us as the presentations were going on, you're welcome to the second edition of the Mid-Year Economic and Market Outlook webinar. And we are hosting this virtual event to share insights and predictions or expectations on trends that will shape the second half of the year, just to equip ourselves with the necessary information to make the right investment decisions going forward, right? And so you're welcome once again, and we'll go straight to the Q&A portion of the webinar. I'd like to remind you that if you have a question or you'd like something clarified from the presentation, kindly submit your points or your question in the Q&A tab at the bottom of your screen, and we'll pick it up and address it to the relevant speaker to provide some clarification or answer your question. And so we'll take the first question that came through, and Nana Wiafe, this goes to you. So the question is on risk management strategies. And so the question reads, what are Axis Wealth's risk management strategies in the management of our investments? And so Nana, I would ask you to turn on your video and your microphone and kindly respond to that question.
Right, Albert, thank you for the questions. So in our approach, risk management begins with the financial planning process. So we start by understanding your goals, your ability to take risk, which is determined by your current financial resources and your net cash flow. And number two, your willingness to take risk, which is more temperamental or behavioral. Right? So based on these factors, we align your investment with your risk preference and return objective. This alignment helps mitigate risk right from the onset and also ensures that we do not invest for growth for you. As an example, if you are risk averse, right? We further mitigate risk through diversification. Our investment strategy involves using model portfolios with index funds as the building blocks. This diversification reduces risk by spreading investment across a variety of assets. Additionally, we stay with you throughout your investment journey, rebalancing your portfolio and making necessary changes when necessary. This ongoing management provides assurance that we are constantly monitoring your portfolio and addressing the inherent risk with every investment. Having said this, it is important to note that market risk is inherent to every financial investment. The best we can do is to reduce market risk through diversification and align the investment we do on your behalf of your risk tolerance, but we cannot entirely eliminate risk. Thank you, Albert.
Thank you very much, Nana. Thank you. So we'll move on to the second question, and this goes to Gideon. The question reads, with what is currently happening in our Ghanaian economy, is it worth investing in the money market or in money market instruments?
Oh, thank you very much, Albert, for the question. So I would start answering this question by providing some overview of what has actually gone on in the Ghanaian economy. We all know we just came out of a debt restructuring involving both the domestic and foreign or external debts that the country had. That also puts the country in a position that we're not able to honor our debt obligation, or we're not sound enough to be able to fund those obligations, and we had to revise the terms to be able to get along again. So with this in context, I think investing in money markets in Ghana, it definitely depends on your investment goal and risk, how much risk you are prepared to take on. With the debt restructuring, we've seen that there is no free lunch. We've always called government to be risk-free, but now we all understand that there is some risk involved there. So first, you have to assess yourself that are you in a position to take any hit? That is not to say that there is something going to happen again in terms of government's obligation, government not being able to honor its obligation. But with something like this happening before, you have to factor it into your risk analysis. And then also your investment goal. What do you seek to achieve? Whatever funds you want to invest, are you able to give it to governments and states, or I mean, it matures. So there's no straight jackets to of answer to this. You just have to assess the risk involved in lending or borrowing to governments, and whether, I mean, it meets your investment goal. Thank you, Albert.
Thank you very much, Gideon. Thank you so much. And so our next question, our third question, is on the expectations on market performance. And so the question is, the S&P is at an all-time high. What are the key drivers, and what should we expect by way of market performance, investment returns, and yields going forward? I think, Peter, this is a question for you. So if you could kindly unmute and turn on your camera.
Sure. Thank you, Albert. So this question is interesting because the essence of being in the bull market is having, record highs. Markets are at record highs at this point. However, we're in a bull market, which is we're carrying the second year of the bull market. So we expect the market to continue to move higher. So far this year, if you look, take a look under the hood of market performance, about 80% of the market performance has been driven by just 7 stocks, which has been referred to as the Mark 7. But lately, we've seen other parts of the market starting to participate in the performance, and so we've seen a broadening out of markets, performance, and we continue to think that this rally is going to continue into the next half of the year. So we do believe that even though we are at record highs, we're in a bull market, and so we expect the market to continue to move higher. And that will be the first part of my answer to this question. The other aspect of it is we continue to expect that markets will move higher based on rates coming down. So if equities, for instance, are valued, based on interest rates, when interest rates are high, it makes valuations low, and when rates are low, it makes valuations high. So if rates come down, we expect that the value for the markets and individual companies is going to be higher based on lower interest rates. And that's why anytime the Fed, speaks, or the Fed alludes to potentially, cutting rates, the markets rally very significantly. Sometimes the markets get ahead of themselves, and so we see pullbacks. But this is not to say that it's going to be all rosy going forward. We believe that there's a lot of volatility in the market. The Fed is trying to do something that has not been done before, trying to engineer a soft landing that has not been done before. And so it's going to be tricky. And that is going to present a lot of opportunities. So I mentioned earlier on that a lot of sectors in the market look very, very expensive. Valuations have been stretched. And so in our firm, we believe that any pullbacks going forward represents a buying opportunity. So a lot of companies that are looking very expensive at this point, when they pull back 5%, 10%, that's when we'll be adding, as long as we still like, those companies and that part of the market. So to answer your question, with all that being said, we still think that the markets are going to continue trending higher. It's not going to be a smooth path, but we think that we're going to be higher at the end of the year than we are right now. Thank you.
Thank you, Peter. And I'll ask for you to stay on for me just a bit for a follow-up question. So there's another question which is on a point that you touched on the fact that we are in a bull market, and so the attendee wants to know if we are, when do we have an expectation on when this trend will turn around, when this will come to an end?
So that's a hard, question to answer. Nobody can predict, what's going to happen in the future. We can only make our decisions based on what we know now. What we know now, looking at what's happened in the past, using history as a guide, second year of a bull market. So this current bull market started last year, right? 2022 was a terrible year. All asset classes, were down. For the first time, we saw both equities and fixed income, in negative territory. 2023 was the first year of the bull market. And this year is the second year of the bull market. Typically, statistics and history shows that second year of the bull market continues to be very, very strong. And though that gives us optimism to stay in the market. Another statistic that makes staying in the market, or favors staying in the market, is the election cycle. So typically, election years, have been positive, regardless of who wins the presidency. It's usually, better for the market when we have a divided government. I mean, I'm referring to the US markets at this point. When we have a divided government in the US, it's usually better for the markets because policies that are passed or implemented tend to be more collaborative because if we have, one party in the White House and another party is controlling Congress, they have to work together compared to when it's a sweep. So if it's, one party has both the White House and Congress, they tend to, go extreme and implement policies that do not really, last or bode well for the market. But statistics and history shows that in election years, the markets, have been positive. So those are just two, data points. And we think that also valuation continues to be attractive in, parts of the market. Not every part of the market looks attractive as far as valuation goes, but we see the trends looking very, very attractive compared to history. And one other point that I'll add to it, as far as history goes, is the fact that we've never had a recession with unemployment, below 5%. Unemployment has been creeping up, like I said earlier on. It's gone from 3.6 to currently at 4.1, but that's still a very, very strong economy. And GDP continues to be positive. And so we think that, and we strongly believe that all those continue to be, tailwinds that will likely, lead to us having a positive year this year. And that is not to suggest that, anything unexpected cannot happen. We have, two hard wars going on right now, and Ukraine, Russia continues to be a problem. Gaza, between Israel and Hamas continues to, be a problem. But the markets, have kind of been insulated from all these, and continues to trend higher because we're not seeing any major disruption, like events like COVID, had on the global economy 4 years ago. And so nobody knows what's going to happen. But based on what we know now, we think that the market is going to be higher by the end of the year from where we are. Thank you.
Wonderful, wonderful. Thank you so much, Peter. And I'll let you rest for a bit and I'll come back to you. Thanks so much for those insights and the details that you shared. Sharing it for free. We really appreciate that. And so, yeah, so we'll continue with the Q&A portion of the webinar. As we promised at the beginning that it was going to be an engaging session, and we are excited that would be able to fulfill that promise, considering all the questions that are coming in. And we'll continue to encourage you to submit your questions in the Q&A tab at the bottom of your screen if you have any concerns or clarifications to make. And so we'll move on to the next question. And Nana, if you could kindly unmute and respond to this one for me. So the question or our participants would like to know, how can one navigate the restrictions being imposed by Bank of Ghana on Forex accounts and transactions?
Albert, thanks for the questions. So on that, currently, there is no law from the Bank of Ghana restricting foreign exchange transfers for investment purposes, provided a transfer is supported by all the necessary documentations. Right? And what we do here is we assist our clients by providing all the required documentation to meet that BOG requirement. However, some banks may use the BOG recent scrutiny as an excuse to restrict FX transfer, even going as far as requesting tax clearance certificate from clients who want to transfer their own money outside, which is generally required only for foreigners transferring money out of the country, right? But the good news is there are a lot of banks capable of executing FS request transfer on behalf of clients with proper documentation. So if your primary bank is causing you difficulties, consider switching to a bank that can better facilitate your FS transfer needs. So there's no restriction on FS transfer, right? We run an open FX regime. And I don't think Bank of Ghana would ever do that. It sends a very wrong signal. Thank you.
Thank you so much, Nana. And so, yes, our advisors at Access World can support you and provide guidance on which banks can support your desire to explore offshore investment. So kindly reach out and or share your contact details, and would certainly provide that guidance. And so we'll move on to the next question. And Gideon, if you could kindly prepare to respond to this for me. The question reads, can you share any investment strategies or tips for navigating market volatility and achieving long-term investment success?
Okay, thank you, Albert. So market volatility strategies mainly revolve, there are several strategies, but I would just like to focus on some broad themes which helps in navigating a volatile market. The first one is diversification. You would have to be able to build your portfolio in a way that is diversified across board, so that you are not exposed so much to idiosyncratic risk. That's risk from just one stock of volatility from a concentrated area, which can have a significant loss effect on your portfolio. So one, your portfolio has to be well diversified. The second thing would be for you to be able to find a company that is able to absorb some of these volatile nature or volatile markets, in the sense that when there's so much volatility, they don't pass it, or they don't get so much affected by it. And for long-term investment success, the only thing is have your goal and follow, or have a structured way to help you achieve your goal. So persistency has to play in there, and that would ensure that you are successful with your investments.
Thank you so much, Gideon. And if you could stay with me and answer this question. So our participant wants to know what the prospects for the economy and exchange rates are post-election in both Ghana and US. So I think Gideon, you can handle the response from a Ghanaian perspective, and then Peter can provide a US context to complete the response to this answer. So if you could answer the question, what are the prospects for the economy and exchange rate post-election in both Ghana and US? So Gideon, over to you.
Thank you, Albert. So from Ghanaian economic context, the cedi is highly tilted towards depreciation. This is from now till post-election. We are on an IMF program, and we have to stick to the IMF targets. We are largely tilted towards depreciation, and for us, our in-house target or forecast for year end is somewhere around, currently we are around the 15 cedi level. We should be seeing somewhere around 16, 17. For next year, whether there's a change of government or not, our economy is still in a recovery phase, and the real sector that should, really drive and support the cedi to be stable is still experiencing that recovery. And so it would still largely be tilted towards depreciation. Thank you. And I mean, from the US context, I think Peter even shared some insights on that interest rates will remain higher for longer, despite the fact that we are expecting monetary policy to ease. And with interest rates, I mean, staying higher in the US, that is expected to contribute to the dollar's strength. The dollar is likely to strengthen because that would attract more investors and create more demand for the dollar. So I don't know if Peter has something to add to this.
Yeah, sure. So thank you for the question. And Gideon, thanks for the early part of this response. What I'll add to that will be twofold. So first off, like you said, we expect the dollar to remain higher for longer. That will mean that, you know, other currencies are going to remain slightly weak compared to the dollar. And the economies that usually bear the brunt of a strong dollar are typically emerging market economies, because most of the economies are dependent on borrowing from outside, and they have to pay back, you know, with hard currency. And that's why we continue to see the CD depreciate, you know, so fast because of over reliant on the US dollar denominated, you know, debt. Not talking about other parts of the economy that are dependent on the US dollar. I'm just talking about, you know, fiscal and monetary policy. So the dollar is going to stay stronger for longer, and that, you know, leads to the prudence of diversifying one's domestic investments with a foreign denominated investment. So if the CD continues to, you know, trend lower, one way to hedge against that risk is being, you know, exposed to a stronger currency, and that's where the Access, you know, wealth management, you know, investment or financial wealth management products come into play. So we're able to give you access to global markets, you know, to invest in US dollar denominated investments that will help, you know, to hedge your domestic investments, diversify away from being concentrated in the Ghanaian market. And also that will enhance your return, because if you are earning dollars, which is a stronger currency, and you convert it back to to Ghanaian cedis, which is likely to continue to be weaker, then your returns, you know, are even compounded. So that makes, you know, a very, very economic sense to, you know, invest, you know, in US denominated investments. And then the other part of the question is as far as the elections go. So the interesting thing of this particular election cycle in the US is that both, you know, incumbents, so first of all, prior to Biden dropping out, it was Biden versus Trump. Both of them, for the first time in a long time, we're going to have two potential, you know, two candidates that already have a track record. They've all been presidents before. So the markets know mostly what to expect from Trump because he's had one term before. And Biden also is incumbent. So we kind of know what to expect. However, with Biden dropping out and you know, Harris being the top of the ticket, she is likely to continue with the Biden policies. And so to a very large extent, you know, regardless of who wins the elections next year, the market is already pricing in what to expect. That we're not going to have any major surprises. We're likely to see, in the potential Trump administration, we're likely to see more trade restrictions, you know, with China and, you know, whoever else, whichever other country he wants to extract some kind of deals from. And we're likely to see deregulation, which will likely, you know, bode well for the energy sector and also financial sector. We're likely to see the tax, you know, cuts that were passed during the Trump administration, likely they're about to expire in 2025. There's a likely chance that he will like to extend those, but that may not be, you know, possible because of the amount of stimulus, the amount of deficits that, you know, has piled on over the last 8 years. So that may not be successful. But as far as, the Democratic Party winning the presidency, we think that it's going to be, status quo as far as what is currently going on will likely be continued, regardless of, whether, with Harris, leading the top of the ticket at this point, we're likely to see a continuation of the Biden policies. So that's what the markets believe as far as elections in the US, goes.
Wonderful, wonderful. Thank you so much, Peter. And so would Peter, if you could stay with me for the next question. Our participants would like to know if you can share some insights on the best investment opportunities and wealth protection options for individuals with a long-term view.
So as far as investment opportunities, it all depends on the individual client situation. It depends on the person's goals. But in general, for long-term investments, the best hedge, also the biggest risk, to long-term investing is inflation. And the best hedge to inflation is equities. And so if you have the luxury of time, if you're nowhere near retirement at this point, if you're not in retirement, or you have a big, asset base to invest, we recommend, having exposure to equities. Equities have been the only asset class that has consistently beaten inflation on a long-term basis. We may see volatility, in the short and medium term, but long-term equities always, win out. So if you're asking what would be an investment strategy for a long-term investor, assuming you have the means to absorb the volatility, my recommendation would be to have equity market exposure. However, it all depends on the individual's, situation and their risk profile. And that's what makes talking to an advisor very, very important. So that would be my, short answer.
Thank you, Peter. Again, I'll let you catch your breath and then we'll come back. There are a lot of questions and a lot of them are for you. So I'll let you catch your breath and we'll come back to you. We are also joined by our resident legal advisor and estate planning expert, Mrs. Louisa Xiao. And so Louisa, if you could prepare to answer this question for me. The attendee wants to know, how do I pass on my investment to my family when I am no more? I think this is both with regards to their investments through partnering with Access Wealth as well as other investments. So Louisa, if you could kindly unmute and turn on your camera to respond to the question.
Okay. Good afternoon, Albert, and good afternoon, everyone. In terms of passing down the investment to your intended beneficiaries, at Access Wealth, when you invest, the information we take down has to do with your next of kin. So we don't take details of your intended beneficiaries. So the moment you sign up with our product, you need to make sure that if you already have a will or any form of an estate plan in place, you have that updated, because chances are the funds will be moving from a bank account, which you've already probably catered for. But the moment the funds leave the bank account and comes into this product, it means they are out of, if it's a will, they're basically out of the will. So you'll need to update your estate plan. And if you do not have one, then this will be a good opportunity to have one in place. Now, in terms of, in general, products like insurance and pensions, thankfully, you have the option of nominating your beneficiaries. So for those kinds of products, I always say that always make sure that you have completed your beneficiary details And as often as you can, maybe on an annual basis, do check and make sure that your beneficiaries are up to date, because either you're having more children or some of your intended beneficiaries have passed on. In terms of your other assets, whether it's shares, whether it's landed property, immovable property as well, general rules apply. If it's passing it on, you can do it via a gift. So you can execute a deed of gift. For specific assets like properties, there's the law governs how you can transfer those assets. So you can either do an outright gift where you go through a lawyer to help you draft a deed of conveyance or deed of assignment. And you also have the option of passing it via a will, or for clients who prefer the trust option, you have the option of setting up a trust where you have to select your trustees and then go through a process of drafting through your estate attorney or professional drafting a trust deed and selecting your intended beneficiaries. And they will also take you through the process of any dispositive arrangement or any administrative arrangement. So generally speaking, these are I'll say the broad examples by which your investments can be passed on to your intended beneficiaries, either directly through a gift, by will, or trust. And for the specific ones, like I mentioned, pensions, insurance, you can do that via your beneficiary details. And then for some jurisdictions as well, I'm sure you've heard of family offices. They have for the multi-millionaires or billionaires. Some do it through foundations. So there's a lot of options, but just like with your investment, the estate planning objectives of everyone is very different. So depending on what your objectives are, you need to sit with a professional and then they will take you through which of the options best suits your needs. Thank you.
Thank you very much, Madam Lawyer. Thank you so much. I believe you have answered that question, sufficiently. And so, if you are on this, if you're in this webinar and you need more guidance on how to properly structure an estate plan or a transition plan, once again, kindly share your contact details and we'll connect you with Louisa to help you put that together. And so we'll move on to our next question. And I would like to say thanks once again for joining this webinar. Thank you for all of the questions that are coming in. We'll do our very best to respond to all of them. But please bear with us as we go through the questions. And so the next question, Nana Riafe, if you could kindly unmute and turn on your camera for me to respond to this question. The question is related to the S&P. And so the question reads, yesterday, the S&P fell to 2022 levels. NASDAQ also fell. How can one comfortably invest? And the second part of the question is, secondly, is Atlas a subsidiary of a bigger company or is it a standalone company? Nana Riafe.
Well, Albert, thanks for the question. And thank you, dear listener, for asking this question. I'm happy to know, you are following, market. So yesterday, saw the biggest drop on record since 2022. It didn't drop to 2022 level, right? So the S&P yesterday dropped by 2.3%. And that was the biggest drop we've seen in a single day. Prior to that, the biggest drop in a single day happened in 2022. So as we speak, from end of year 2022 till date, the S&P is up by over 16%. The NASDAQ is up by over 30%, right? So it tells you, we've seen, growth. Of course, those are equities, and equities, comes with risk. And once, you are coming in, for instance, as an aggressive investor, and we are investing a bit of your pot in the S&P or the NASDAQ, these are drops you should expect, right? I mean, we can't protect you, I mean, from this drop. That is why we want to really understand what your risk appetite is before we invest. And also, I mean, this should, I mean, tie in with your horizon, right? I mean, if you tell me you are aggressive, but then you have a 3 months time horizon to invest, there's no way we'll do equities for you. Because in 3 months time, I mean, your $100,000, I mean, could be $90,000, right? And then you wouldn't be happy. So yes, I mean, these volatilities are to be expected. It is part of market. But then if you give it time, right, over a 25-year, I mean, period, the market is up by over 12% on the average. So market would give you return if you are patient. Now, Access Wealth is a SEC license, I mean, business. It's a separate, I mean, business. And Access Wealth is owned by Access Pension Group. Access Pension Group also owns Access Pension Trust. The idea behind Access Wealth, I mean, really is to provide boutique wealth management services to our clients. Mostly, I mean, our pension clients who are looking for other solutions outside of pensions, right? So that is how it's been structured. It's a separate company, SEC licensed, and the objective, I mean, really is to offer the individuals within a bigger, I mean, pension clientele base, the opportunity to diversify outside of Ghana. Thank you.
Thank you so much, Nana. And if you could stay on for this next question. So the question is in 2 parts. I think, Nana, you can answer the second part, and Peter would provide some insights on the first part of the question. And so our participants would like to know, what are the benefits and risks related to investing outside of the country, and also what expenses are incurred when transferring funds outside. So I think, Nana, please, if you can touch on the expense portion of the question, and then Peter can also chip in with the benefits and risks related to investing outside the country.
Right. Thanks for the question. So, I mean, the expenses, I mean, it's really bank specific, right? With cost ranging from between 0.75% to about 1.25% of the transfer amount, including sometimes a fixed SWIFT charges of about $20, right? So those are some of the expenses, I mean, you incur when you are transferring from your CD account. However, if you have a USD account in country and you are moving money from a USD account to fund your offshore account outside, there's an additional 1% charge in addition to the 0.75 to 1.25%, right? And that is really a charge that goes, I mean, to BOG for externalizing, I mean, dollar or sending dollar outside of the country. So the fee is pretty much what it is, 0.75 to 1.25, depending on the bank, depending on the size of the amount you are transferring. And then if you are doing from your USD account onshore, there's an additional 1% charge. Thank you.
So to add to what Nana has just said in response to the question, so talking about risks and benefits of investing outside of, you know, local jurisdiction, I'll say I'll base my comments and preference them on the US markets. So the US, you know, equity or investing market continues to be the largest in the world. Very, very deep market, very, very resilient, and it's been around for a really long time. They've, you know, always rebounded from various, you know, economic declines. Markets have always rebounded, and so it's been tried and tested. They've had, you know, some difficult times, but the US markets always rebounds. And so I'll say investing outside of Ghana and investing in the US in particular, there's a lot more benefits, you know, than you know, the other way or otherwise. So one of the I'll say one of the risks of investing outside of Ghana is actually, is more of a benefit, than a risk, in the sense that one of the risks of investing outside of your jurisdiction is foreign exchange, risk. Now, in this current environment, the foreign currency is actually looking stronger than a domestic currency. And so I think that for a typical Ghanaian investor, at this particular point in time, investing outside of Ghana is actually very, very prudent, and it makes a lot of economic sense. So I cannot really think of any major risk at this point. Your investments in the US, will be insured, to Nane's earlier point, up to about 30.5 million with our current broker dealer. And the broker dealer is regulated, by some of the strongest regulations that you can find, in the world, both the SEC and also FINRA, regulating these broker dealers. And if they make any, violations, they stand to be charged with huge fines. So there's a lot more protection as far as investment, protection goes. Investing in the US than I can see, here in Ghana. We've had, a lot of investors have had some bad experiences in the past, simply due to the fact that there were not many investment opportunities in the country. So with that, lack of opportunities, rogue advisors took advantage of the situation and sold, bad products that, people that didn't make sense. Nobody understood, and just took, investors' monies. And so that has had a very, very bad reputation on the industry. And so it's been one of the, goals of professionals such as us to find, the right, investment products to fill the void, that has been in existence for a very long time. Because if, the right professionals do not, take the mantle and the responsibilities to find the right investment opportunities for investors, then we'll open up the space, for rogue advisors to take advantage of investors. And so that's one of the reasons that motivated us to, to start Axis Wealth Management and to look for, good investment opportunities that, are simply, in the client's best interest. And that's why we set it up such that we are not, tied to any particular, firm. We are solely independent. We don't have any proprietary products. We only charge a flat fee, and we actually work in our client's best interest. So we go out, look for the best products that suits, the client's portfolios, and we put them in, and we can change them at any time because we're not tied to anybody. So I'll say there's more benefits, to investing and diversifying your portfolio with international investments than there are risks. Thank you.
Thank you so much. Thank you so much for that, Dana and Peter. Yes, at Axis Wealth, we are truly a fiduciary in the full sense of the word. We are independent and we work in your interest. And so I think in the interest of time, we'll take a last round of questions. I'll start with Gideon. Gideon, if you could unmute and answer this question for me. What opportunities apart from T-bills are available for investment for a conservative investor?
Thanks, Albert. So apart from treasury bills, there are no straightforward products or recommendations. However, I would acknowledge that when you look at the risk spectrum, there are still products that can be, found at the very low end of the spectrum. So the thing is, risk across board in the country has evolved to a higher level. So assuming you were doing treasury bills as a conservative investor or a mutual fund as a conservative investor some time back, and you were rating the risk at 1, now, even though it's still at the lower end of the spectrum, mutual fund might be carrying a risk of about 5. And so all I'm saying is, there is no straight answer. Whichever product that is at the lower end of the risk spectrum, the investor or person has to carefully analyze again. And so you can't say that in the past, mutual funds or collective investment schemes were recommended for conservative investors. And so you are still going to do that. And that's why we are there, to help you reassess and discuss your goals, reassess your risk level, and help you adjust whether that product would meet, your specific need. And so apart from T-bills, there are other options on the market, but it would require a discussion with your financial advisor to help you make the right decision.
Thank you very much. Thank you very much, Gideon. And I think we'll go to Peter for the last question, which has to do with Chinese stocks. So, Peter, our attendee would like to know what our views are on investing in Chinese stocks at the moment.
So that's a very, very difficult question to answer, because there's so many Chinese stocks, and there's so many sectors. If you're talking about stocks in the real estate space in China, and that's a no-go at this point. If you're talking about consumer space, for instance, consumer discretionary, yes, that could be attractive. If you're talking about tech-related stocks in the Chinese market, that could be attractive. But it all depends. So the Chinese story is a little delicate at this point, due to the fact that so there's more optimism on the Chinese consumer than there is on the Chinese state. And so there's still a lot of state control when it comes to what companies can and cannot do. If you look at what happened with Jack Ma recently, and being forced to break up Alibaba and sell Alipay, or divest of Alipay from the company, and also losing control of the company. It takes it lends a lot of it leads to a lot of worry about investing in the Chinese market. It all depends on on how the Chinese government views the owners of the company, and what they think is in the best interest of the Chinese government. And so one can still invest in Chinese companies, but you have to be aware of the risks that are involved and what sectors you're going to invest in. The more that the trade tension between the US and China goes on, the harder it is for certain sectors in the Chinese markets, to do well. And so you definitely need to be very, very careful, and know what they're investing in and what the risks are involved. But there's still companies that are doing well in the Chinese economy. You just have to be very, very selective. That will be my my short answer to that.
Wonderful, wonderful. Thank you for that, Peter. And then finally, Nana, there's a question on how can I partner with Access Wealth to be able to take advantage of stocks like Facebook and Google. So Nana, if you could briefly touch on that question for us.
Sure, but thanks. So I think Albert, leave our info at Access Wealth Management, email on the platform, and then we can take this further. However, for what we do, we have two main type of accounts. The discretionary account, where the minimum is $25,000. Once you are coming in there, you are kind of subjecting yourself to our advice as to what you can do. We have the non-discretionary option, where we can help you with an account, and then you can pick your Facebook and your Teslas, etc. But then the required amount over there is a bit huge, right? 100,000 plus, right? That's what is required for that account. So there may be some exceptions. We can make some exceptions, but basically just leave our contact, and then we can take this further. Thank you.
Thank you so much. Thank you so much, Nana. So yes, and in the interest of time, we scheduled the webinar to go to 3:30, and so we have exhausted our time. We'd like to say thank you for joining us today. We hope you enjoyed the discussion and found the insights valuable and found the session engaging. We encourage you to speak with our advisors to discuss your specific needs, and our contact details will be displayed on the screen once the proceedings come to an end. And we'll share a post-event survey with you to help us improve our webinar experience. And so we encourage you or entreat you to complete that survey for us once the webinar is over. And so thank you once again for joining us for the second edition of the mid-year webinar. We look forward to hosting you at future events organized by Axis Wealth, and we wish you well and success with your investments going forward. Thank you and have a wonderful day.